Welcome to your daily solo 401k webinar Q&A session with my solo 401k financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic: can I use rental income for a solo 401k? This is a question we get quite often, especially those who are looking to establish a solo 401k plan for the first time. So they're trying to determine whether they are eligible or not. So again, this is one of the most common and misunderstood questions we get from self-employed individuals out there, or those who are exploring opening a solo 401k plan. So why is this question so important? Well, because not all income qualifies for both solo 401k eligibility purposes and, as a result, for contribution purposes. So a lot of professionals out there, or even investors that invest in real estate through their personal funds, for example, they might be landlords, for instance. So they're passively investing in real estate, which would be subject to capital gains. So a lot of landlords think that rental income equals business income. Well, that's not always the case. The truth is that rental income is generally not considered passive income, and therefore not earned income for self-employment activity for solo 401k eligibility purposes. And solo 401k contributions can only come from active self-employment income. That's income that's subject to self-employment income tax, for example. Whereas a lot of real estate income is typically subject to capital gains income because it's passive. Therefore, it's not subject to self-employment income. And in order to open a solo 401k, you have to be performing material services. So you have to be doing the actual work and then getting compensated for doing that self-employment activity. So if you're simply collecting rent from tenants, that's not enough to qualify for a solo 401k. But just like everything else in the US tax code, there are exceptions. For example, if you actively manage those rental properties, that means you're doing the actual work. Say you run it like a business. So you provide substantial services or operate through an LLC or an S Corp that reports active income, where you're actually working under that entity, you're doing the work. As a result, you may be able to convert that passive rental activity into qualifying self-employment income. So you're going to want to check with your tax CPA if you are running a rental income type of activity, so that if you want to be eligible to open a solo 401k plan, your CPA can determine what amount of that rental income you can utilize as earned income from self-employment activity resulting from you performing material services, doing work on those properties, and getting compensated as a result. So that's what you need to understand. Okay. So this is your chance to get answers. Use the chat to ask questions on today's topic or anything else. type them over now so that we can be sure to get to them all. Let's continue. Looks like we have a question here. So let's see here. Taxpayer over age 50 has a solo 401k. He made contributions of $31,000. He contributed those to the Roth solo 401k bucket to maximize their deferral. And then they also made a $46,500 voluntary after-tax contribution to the solo 401k. Let's see here. So 31,000 plus 46,500 equals 77,500. So obviously we're talking about tax year 2025 contribution figures here. So obviously this individual qualifies for the catch-up contributions because the individual is age 50 or older. So give me a moment here. Let's get to the slide here where we can talk about contribution limits, and we'll continue to answer your question as well. So give me a moment while I'll get to that slide here. Okay, here's the slide here. So for 2025, the contribution limit is $70,000 for someone who's under age 50. If you're over age 50, like this individual is, you qualify for a catch-up amount of $7,500. And then if you're age 60, 61, 62, or 63, you would qualify for a super catch-up amount of $11,250, resulting from the passage of the Cure Act 2.0. But you have to be within that age range in order to qualify for that super catch-up. You can't contribute both the normal catch-up and the super catch-up, of course. But I'm assuming this individual is age 50 or older, but under age 60, therefore he would only qualify for the catch-up, the normal catch-up amount of $7,500. So you're saying that the $77,500 is rolled into a Roth IRA. Are Form 1099-Rs needed? Great question, especially this time of year as we're approaching the end of the year, and you need to make sure that if you use my solo 401k financial as your solo 401k provider, that you communicate to us by completing our online forms so that we can issue the applicable Form 1099-Rs to report both transfers and in-plan conversions, whether you're converting pre-tax solo 401k funds or voluntary after-tax solo 401k funds. I'm going to share a link. There's a link to our forms page. Take a look at that link, because in this situation here, there's going to be two Form 1099-Rs that are going to have to be issued. The first one is that when you converted the 46,500 of voluntary after-tax solo 401k funds to the Roth IRA, that's part of the mega backdoor Roth strategy, and therefore a Form 1099-R has to be issued to report that mega backdoor Roth conversion. So on our website, you'll want to complete the applicable online conversion form so that we collect the necessary information to issue that Form 1099-R. Since you converted those funds in 2025, that Form 1099-R will be issued at the beginning of 2026. So January, February is when that Form 1099-R will be issued. And we provide that service at no additional cost for our clients as long as they timely request it. Now, the second Form 1099-R that's going to apply in this particular situation is that you also transfer the $31,000 in Roth solo 401k contributions. You transfer that to a Roth IRA. So that's not considered a conversion, that's considered a transfer. Hence why a second Form 1099-R needs to be issued to report that non-taxable direct rollover of the Roth solo 401k to the Roth IRA. And there's a form on our forms tab that you would fill out, a separate form, a transfer out form, that we would collect the information to issue that second Form 1099-R. So visit our Forms tab. Now, one caveat here is that in order to transfer Roth 401k, in this particular Roth Solo 401k contributions out of the plan to a Roth IRA, you have to be at least age 59 and a half. In other words, you're not allowed to transfer Roth 401k funds out of the plan unless you meet a triggering event, which is age 59 and a half or older or no longer self-employed. So the IRS regulations, and that's a statutory regulation, meaning it's an IRS regulation. It's not a per plan regulation. So as a result, if this individual is under age 59 and a half and he's trying to transfer those Roth Solo 401k contributions out of the plan to a Roth IRA, that's not allowed if that individual is not age 59 and a half or older. Now, don't confuse that regulation with being able to convert voluntary after-tax solo 401k funds to the Roth Solo 401k or the Roth IRA. The distinction is that one's considered a conversion, the other's considered a transfer. And we've done a lot of webinars on this particular topic. So it's important to understand those regulations. So again, we've done a lot of webinars on these topics. If you visit our YouTube channel, you can access that webinar. So in other words, if this information is helping you feel more confident about your future, please take a moment to like and subscribe. It tells the platform this content is valuable, which helps other solopreneurs like you to find it. Subscribing guarantees you get notifications of all our crucial content that we deliver every day to help you secure your retirement. Also, visit my community on our website, where we have over 30,000 members. And if you're a financial professional, whether a real estate agent, broker, financial advisor, CPA, attorney, insurance agent, you name it, you can post on our My Community information about your field and your services, and you can even link that post back to your company's website so that the 30,000 plus eyeballs on our My Community site can explore your site to see what services you offer, and hey, they might even reach out for some of your services. So take a look at that. All right, hopefully that answers your question. Let's continue here with today's topic, which is, can I use rental income for a solo 401k? And we get this question all the time, as I mentioned earlier. Let's continue here. So, common misconception when it comes to rental income. And I think we talked about this slide already, but let's review it anyways. So, rental income from tenants is usually not subject to self-employment tax. Therefore, it would not qualify as earned income for solo 401k eligibility purposes, and therefore for making annual contributions to the plan. So again, when exploring whether to open a solo 401k plan or not, more specifically, if you're eligible, you need to make sure that you qualify. It's got to be a self-employed business that offers goods or services, and you're doing the actual work. You also cannot employ any non-owner full-time W-2 employees who work 1,000 hours or more in your business. If you employ someone that works 1,000, and a W-2 employee who's not an owner and he or she works 1,000 hours or more in the business, you cannot open a solo 401k. So again, in the context of rental income, if you actively manage those properties and run it like a business where you're actually doing the work, then you may qualify to treat that as a self-employed business. So some real world examples of self-employed business in the context of rental income. Let's say you operate a short-term rental managing booking business where you're booking guests, So you're actually doing work. That would qualify as self-employment activity. If you're a licensed state professional, whether you're a real estate agent or a broker, that's doing work. A lot of our clients are independent contractors. If you're managing properties like a business, then that would qualify as earned income from self-employment activity, as long as you're drawing some type of salary. I mean, obviously, the benefits of qualifying for a solo 401k are obvious. We talk about this every day. So, for instance, for tax year 2025, you can make high contributions with a solo 401k up to $70,000 for someone who's under age 50, or even more if you're over age 50. And of course, from an investment perspective, you can invest solo 401k not only in equities, but also real estate, like real estate syndications, rental properties, land, and so forth. And you can invest it whether through the Roth solo 401k or the pre-tax solo 401k, and it's all going to grow tax deferred or tax free in the case of a Roth solo 401k. So the self-directed solo 401k advantage is that you can invest a self-directed solo 401k and alternative investments by writing a check or by wire. And you're going to have separate holding accounts under the plan to hold your various contribution sources, whether it's pre-tax, Roth, or voluntary after tax. So in short, can you use rental income to qualify for a solo 401k? Well, it depends whether it's passive versus active. Passive, you would not qualify to open a solo 401k. Active, yes, meaning you're managing the properties, you're doing the work. That may qualify, it typically qualifies, but you want to double check with your CPA whether it makes sense for you to work under that business so you can treat it as earned income from self-employment activity. Because again, if you treat it as a business, that's going to be subject to self-employment income tax. Whereas if it's a passive, it's subject to capital gains. So your CPA may say, well, it's better to have your properties used as passive for capital gains versus active if you're trying to be self-employed. All right. So with the solo 401k, we've talked about this a little bit. So it's a retirement plan for the self-employed. So owner-only businesses where where that business does not employ any non-owner full-time W-2 employees who work 1,000 hours or more. If you employ an individual that works 1,000 hours or more in your business who's not an owner, then you would not qualify to open a solo 401k. Now, you can exclude anyone who's under age 21. So regardless if that individual works 1,000 hours or more, if he or she is under age 21, then you can still open a solo 401k plan because you can exclude those who are under age 21. And the solo 401k allows for various contribution types: employee, pre-tax or Roth, employer pre-tax or Roth, as well as voluntary after-tax contributions. So a solo 401k is ideal for freelancers, consultants, real estate agents, and small business owners that do not employ any non-owner full-time W-2 employees in their business. And some of the highlights of the solo 401k, besides making high annual contribution limits, is that the government will subsidize the cost of opening and having a solo 401k for many years to come through the auto contribution credit, which is a $1,500 credit. Let's see if we can pull some information about that $1,500 credit. So the $1,500 credit became available starting January 1st of 2024, and it can be added to both new plans and existing clients. So if you're a client of my solo 401k financial from December 2023 and prior, we can update your plan so that it qualifies for the auto contribution credit, and you're going to be able to claim a $1,500 auto contribution credit for having a solo 401k plan. So it's available to both existing and new accounts. For new plans that were open January 1st, 2024 and after, we automatically provide that feature in the plan along with the applicable schedules. But if you're a client from December 31st of 2023 and prior, your plan would need to be updated to allow for that auto contribution credit. Let me send over a support ticket for existing clients that would like to have the auto contribution credit added to their plan. You can submit a support ticket because your plan would need to be updated. And we're going to talk a little bit more about this $1,500 auto contribution credit because it's a really good subsidy that the government has provided. So it's a dollar for dollar tax credit up to $500 per year for a maximum of $1,500 over a 3-year period. So it's $500 for, let's say, right now we're in 2025. So if the feature is added to your plan, or if it's if it's a new plan, you would be able to get a $500 credit for tax year 2025, a second $500 credit in 2026 tax year, and a final $500 credit in 2027 for a total of $1,500 over that 3-year span. But you have to have a solo 401k plan from a provider like my solo 401k Financial, who provides a plan that has the auto contribution and related schedules built into the plan. Traditional solo 401k providers like Fidelity, Schwab, Chase, Wells Fargo, T. Rowe Price, Ascensus, those firms typically do not provide a solo 401k plan that has the auto contribution credit built into it. It's a dollar for dollar credit that can be added to both new and existing solo 401k plans, as I mentioned earlier. So with these credits, the ultimate cost to both open and maintain a solo 401k is practically free. Now, you're not required to contribute in order to qualify for it. Now, a tax credit, it's not merely a deductible expense. It's a dollar for dollar credit. So it reduces your taxable income on a dollar for dollar basis, your business income. And again, you don't have to contribute, even though it's called the auto contribution credit, you're not required to contribute in order to take advantage of the $1,500 auto contribution credit. So that's what's great about it, is that you just need to make sure you have a solo 401k plan that has that feature built into it along with the related schedules. As a matter of fact, you can opt out of contributing and you still qualify, and you're still going to be able to contribute to the plan up to the overall limit, or you don't have to contribute at all. And as I mentioned earlier, you're going to claim that credit each year for a total of 3 years in $500 increments. You're going to use Form 8881, which is an attachment to your business tax return. It's a 2-page form. We do have a video walkthrough and a PowerPoint that we would share with our clients to help them file that Form 8881. Okay, looks like we have some questions here, or let's see here if we do or not. We may not have any more questions at the moment. Here's one. What other brokerage can we use to invest in equities besides Schwab, E-Trade, and Fidelity? Great questions. Short, you get to choose the brokerage firm. We don't have a say in that, and that's probably why we're so popular for solo 401k plans. And we have a lot of institutional clients, a lot of advisors, CPAs, and attorneys use our services because their clients may want to use their local bank or a brokerage firm. Another one that we see a lot of clients using is a company called Altruist. But at the end of the day, we let you decide. It just comes down to whether or not that brokerage firm that you choose will be willing to provide a brokerage account for a solo 401k plan offered by a third party like my solo 401k Financial. And we'll shepherd you through the setup process. I know we have a lot of LPL financial advisor clients, Edward Jones advisors clients, Ameriprise financial advisor clients, and they use their broker dealers to open up the brokerage accounts for the solo 401k that we offer. And they like that because our plan has that auto contribution credit I just mentioned. It also comes with all the bells and whistles, meaning you can do the mega back to Roth conversion, make employee and employer Roth contributions, process solo 401k participant loans. Even though most advisors don't have their clients invest in those funky alternative investments like physical real estate, cryptocurrency, precious metals, that is a feature available with our plan as well. But we also perform the compliance reporting for the plan, like Form 1099R and Form 5500 Easy for those who timely request it. So again, you get to choose where to hold the funds at. But here at my solo 401k financial, we specialize in being the solo 401k provider and providing the ongoing compliance support for clients who timely request this. And again, a lot of advisors, professionals use our services for the reasons that I just mentioned there as well. So here's a good slide to look at regarding my solo 401k financial. These are all the type of plan support we offer at no additional cost. It's all covered in our annual fee of $125. You just need to make sure that you timely request this type of reporting, like Form 1099R for distributions, conversions, transfers, Form 5500 Easy, which is an informational return, which applies once the market value of the solo 401k plan is greater than $250,000, or at plan termination, regardless of value. And as long as you timely request these services, we'll provide them at no additional cost. So good question. Another question here. What's the difference between 401k Roth IRA and personal Roth IRA? Can I contribute to both? And if so, funds will be coming from personal funds. Great question. So there's the Roth IRA and then there's the Roth Solo 401k plan. And we've performed webinars on this topic. If you visit our YouTube channel and subscribe, you're going to have access to all those webinars. But we've covered this topic extensively. But in a nutshell, one's an IRA, the other one's a 401k. So that's a big difference. So with the 401k, that's for someone who's self-employed. I mean, if we're talking about a solo 401k, in order to open a solo 401k, you have to be self-employed. And it's the solo 401k plan that allows for various contribution types, such as Roth, pre-tax, and voluntary after-tax solo 401k contributions. See if I can pull up that slide here. That'll help compare them. Give me a moment. It's like my slide deck here got kind of mixed up. Give me one moment here, please. Okay, so with the solo 401k plan, it's considered just one plan that allows for various contribution types. If you look at the image on the left here, that's an example of a one participant plan versus the image on the right, which is an example of a two participant plan. A one participant plan would be if it's just one business owner in the business. A two participant plan, an example is, let's say, both spouses. So the business owner and his or her spouse are working in the same self-employed business. So for a one participant plan, where it's just one business owner, then it's going to be one plan that holds pre-tax funds. So that'll be one holding account, aka a brokerage account, to hold the pre-tax funds. The second brokerage account or bank account is for holding the Roth Solo 401k funds. And the third brokerage account is for holding the voluntary after-tax Solo 401k funds, which is part of the mega backdoor Roth strategy. So individuals utilize that voluntary after-tax solo 401k bucket for making voluntary after-tax solo 401k contributions, and then they immediately convert that to the Roth solo 401k or Roth IRA. Now, so it's three separate holding accounts, aka brokerage accounts, for one plan. So it's not three separate solo 401k plans. A solo 401k is a defined contribution plan, meaning you have to have separate holding accounts for each participant and separate holding accounts for each source of funds. So the image on the right, you're going to see a total of 6 holding accounts, because that is an example of a two participant plan. Let's say both spouses are self-employed in the same business. So it's not 6 separate solo 401k plans or 2 separate solo 401k plans. It's one plan with 6 holding accounts, 3 each for each source of funds for each spouse. Now, you can make contributions to a Roth solo 401k. You can also contribute to a Roth IRA. So contributions to the Roth IRA, however, are not impacted by contributions you make to your Roth solo 401k. However, with the Roth IRA, you've got income limits. So if your earned income is over a certain limit, you're not going to be able to make Roth IRA contributions. But of course, you could always do the backdoor Roth IRA. We've done a separate webinar on that in the past. But when you contribute to a Roth IRA, you don't have to be self-employed. Those contributions to a Roth IRA are going to be based on your earned income, whether you work for a full-time employer or you have your own business. Whereas with the solo 401k, you can only make contributions to that solo 401k, whether pre-tax, Roth, or voluntary after tax, if you have earned income from self-employment. In other words, you can make contributions to the solo 401k if you're not self-employed or if you don't have any earned income from self-employment activity. All right, so good question. Looks like we're coming to the end of our webinar here. So today's topic has been, can I use rental income for solo 401k purposes? Go ahead and type over any questions you have. If you haven't yet, we're coming to the end of our webinar. We'll be live again here in a few hours. We go live every day. All right. That's it for today's solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so that we can keep building this community. We'll be back here again in a few hours. Have a good rest of the morning.